In this debrief, we're going to have a look at task 7 from the first sample assessment for cash and financial management. So this task is about methods of investing funds, and we're going to look at different investments and looking at which ones we should go for. So first of all, part A, identify which of the following carries the least risk. So we've got a choice of 4 here. We've got shares in a FTSE 100 company. Remember, the FTSE 100 are the top 100 companies on the UK stock market based on their valuation. We've got UK government gilts. We've got rental properties, and we have unquoted shares. So if you look at the shares in the FTSE 100 company, so these are shares that go up and down in value based on how well those companies are performing. But the issue is that they could go down in value. So there is a risk related to them. Given that they are listed on the stock exchange, we'd like to think that they will be successful companies, but nevertheless, there is a risk they could go down. For the UK government gilts, so these are bonds issued by the UK government when they want to borrow. And in general, the UK government does repay the bonds. So they have defaulted once back in the 1920s when the Wall Street crash happened. But since then, they have always repaid their bonds and they've always paid the interest on those bonds. So the UK government gilts are considered to be quite risk-free. But there is some risk though, because they offer a particular interest rate, and it could be, let's suppose we've invested in a 3% government gilt, but things have changed in the world and interest rates go up to 4%. So there is some risk that we may be receiving less interest on these gilts compared with the market. However, these gilts are tradable and we could try to sell them to somebody else. Next, we have rental property, and this is where we earn income from rent, but there is a risk that the tenants don't pay for whatever reason, and there is also a risk that the property prices go down in value, although in general they tend to go up. So there is risk here because of the tenant's non-payment, and also the tenants may damage the underlying property. And the fourth option is the unquoted shares. Well, with these, this is where they may or may not pay dividends to us based on their performance. But because they're unquoted, there is a greater risk here. These are not going to be the big companies that we have on the FTSE 100. So potentially the value of the shares may go down, but also we may not get any income from them. So of the 4 options, the UK government gilts, I think, are going to be the least risky, given that the UK government does repay its debt. The next part of the question tells us that AZ Modelling plc has £500,000 to invest for 8 months only. 2 deposit account options have been identified as being available for the investment with the following details. So with option 1, we have annual interest of 1.56% and there's no early withdrawal penalties. So notice it's telling us that there is an annual interest rate, but we're investing only for 8 months, so we need to take that into account. So let's have a look at the calculation for this then. So for option 1, we have 500,000 that we have available to invest, and we need to multiply by the 1.56% to give us our interest income for a full year of 7,800. However, we're only going to be investing for 8 months, so we need to multiply by 8/12, and that gives us income of 5,200. So that's our answer for option 1. And then what about option 2? So in this case, we have an interest rate. Again, it's an annual interest rate of 2.4%, but there is an early withdrawal penalty. So if we withdraw within 12 months, then we will lose 3 months of interest. So again, we're going to start off with the 500,000 that we're investing. And in this case, we are earning a larger 2.4%, which means that for the whole year, we would earn £12,000. Now remember, we're only going to be investing for 8 months, so we still need to apply the 8 months time apportioning, and that's going to bring our income down to £8,000. But in this case, because we lose 3 months of that, we still need to reduce that further. So we need to multiply by 5 of the 8 months that we have invested for. And that means we would earn a total income of 5,000. So in this case, it would suggest that option 1 would be the preferable option. Next, MAF Agriculture plc has a portfolio of investments including shares, bonds and property. The current value of each investment and the expected return is shown in the table below. So we need to complete the table by calculating the expected return for investment 4. And we need to enter our answer to the nearest whole pound. And remember that this answer is being marked by the computer in your assessment, so you need to make sure you follow instructions or you risk not getting the mark you deserve. So we're looking at investment 4, aren't we? That was the one specifically highlighted for us. So with investment 4, we have a value of 250,000 that we can invest, and it's going to return 3.1%. So our expected return is going to be the £250,000, and we multiply by 3.1%. Remember, in your calculator, that's the same as multiplying by 0.031. And that gives us a total of £7,750. The total will be automatically calculated for us. That's a computer-generated figure. So that gives us a total of 78,750. And then in part 2, calculate the expected return for the portfolio, notice as a percentage. And it tells us to answer to 2 decimal places. Again, important that you follow the instructions given to you in the exam. So our total income then is the 78,750, and we need to divide that by the total that we've invested. And we've invested a total of 1,750,000. And that gives us an answer of 0.045. And then when we present that as a percentage, here, remember we need to move the decimal point a couple places. So that gives us an answer of 4.5%, or 4.50 if we're going to express it to 2 decimal places. And then in the last part, we're further told that MAF Agriculture plc has a further 250,000 to invest. The portfolio manager suggested the following changes to the portfolio. So first of all, we need to increase the investment 1 to its maximum, as the expected return is 2.2% higher than originally expected. So if you go back a moment, we can see that originally we were expecting a return of 5%. But now we're expecting a return of 7.2%. So that's better, isn't it? So yes, it makes sense that we invest more money. But we got a maximum investment of 600,000. So let's put that in there. So the 600,000 multiplied by 7.2% will give us an expected return of 43,200. In the second bullet point, it says we're going to reduce the investment 4 to the minimum. So it tells us that investment 4, the minimum investment is 150,000. So we can put the 150,000 in our table and then multiply by the expected return of 3.1%. So it makes sense, doesn't it, that we reduce this to the minimum, because 3.1% is the lowest number in terms of our expected return. So once we do that, that means we're going to be earning less income overall, 4,650. And then we're going to invest 250,000 in investment 5. So we put the 250,000 in here. And that has an expected return of 4.06%. So again, when we multiply those together, that gives us an investment return of 10,150. So what about our totals? Well, these totals would automatically update using the software. So we've invested a total of 2 million. And when we add up our expected return, then we get a total of 104,000. the last part of the question asks us to calculate the difference in the expected return. So notice it's the difference in the expected return, not simply what the expected return is. Remember, we had to work out the expected return in the previous part of the question, so the examiner knows we can do that bit okay, but now we're looking at the difference. And it's telling us, again, to express our answer to 2 decimal places. So what we need to do then is work out, well, what is the expected return now? So we have our 104,000 and we want to divide by our 2 million, and that gives us a return of 0.052. And remember, if we want to express that as a percentage, we just need to move the decimal place 2 positions. So that gives us a return of 5.2%. And we need to compare that with the previous return, which was the 4.5%. So let's just compare those. So 4.5. So the difference here is 0.7 percentage points. Again, it tells us to 2 decimal places, so it's going to be 0.70.